Hello, happy October. Hard to believe that 3 quarters of the year are now come and gone. So September month closed, which means the close of the third quarter, moving into the fourth quarter. And we've been talking about how there's this phase transition taking place within the U.S. economy, and that there's a bit of a tug of war between stagflation and deflation. The last couple of days have been very, very interesting in terms of some of the movements in asset classes that typically start spelling out more probabilities of that quad four deflationary cycle. Managing phase transitions, as I've said, are always a little bit challenging because there's different asset classes that work within each. Going through a more deflationary cycle is always interesting because there are times within that cycle where asset classes that traditionally work just don't work. And there are times where other asset classes that don't work actually do work. There's that tug of war. So there's a few things that have been taking place within general U.S. equity volatility that is not good. And basically the three main elements that I'm looking at right now is NASDAQ volatility, a falling price of oil, and an increasing value to the dollar. Now, the last video that I had, you might remember, we were short the U.S. dollar, and that was a function of the math of the market suggesting that the dollar had probably topped out in the near term, and we wouldn't be surprised to see it fall back down to about 93 on the dollar index, symbol DXY. We got that, and so therefore we shorted it. We made a profit on that short, and we've moved away from the U.S. dollar short because it now appears that the dollar wants to be done going down, which could then usher in that fourth quarter quad four deflationary event. Remember, the only place that the US dollar goes up in value is within a deflationary cycle. And one of the things that you have to get a US dollar to go up is a lot of other currencies to go down. And so today we're seeing a number of other currencies across the globe against the dollar actually down. So it's an interesting development. Oil is getting hit actually quite hard. So I'll share a couple of screens with you, try to make this pretty short. Bottom line is that we've de-risked the portfolio in through September. Actually, we de-risked at the end of August because the volatility measurements were suggesting that we could see something uncomfortable in U.S. equities. So when we start to look at what occurred in September, you had the S&P down about 3.5%, the NASDAQ down about 5.25%. And I think on balance, majority of our risk-based portfolios, in other words, from long only to long short to those that are much, much more aggressive and have potentially some leverage in them, I think we were either flat to maybe down a quarter point. So I never like losses, as you know, and I try very, very hard to do my best to eliminate them in these processes. But these phase transitions, as I said, are a little bit weird. What we've done over the last couple of days is completely take down our gold position. And the reason we took down our gold position is there is a very, very heavy embedded inverse correlation with the dollar to gold. So if the dollar goes up, gold gets hurt. And it doesn't look good. And so one of the things that we always look at in terms of identifying when to enter or exit an asset class is what's going on with its volatility of volatility. What is the measurement telling us? Same thing's true with the bond market. Same thing's true with the equity market, currencies, metals, you name it. Doesn't matter. What matters is what's the measurement of volatility suggesting. And the measurement of volatility suggested that for gold, we could see a substantially lower price, like on symbol GLD down to about 172. So let me share a couple screens with you real quick. Let's take a look at gold first. So here's gold right here. We unwound the final amount of our position in gold today. And the reason being was that the signal, the volatility of volatility and the calculus behind the movement of oil or gold in general suggested that we could see it down at 172. And the reason is because the volatility component of gold changed. It went from a range that increased. In other words, its range went from 18 to 23 to a low end of 2022 all the way up to 25. So what's that mean? Well, just like when buying and selling equities, you want to buy when the volatility level is within a range, but at an upper a range bound that is moving itself down, and then sell at the lower range bound that is then moving up. So if we had gold volatility measurements somewhere between the 2022 range up to 25, what this is telling us is that we could see gold volatility easily go up into this 25 range, which would then subsequently take the gold price probably back down to 172. I didn't want to sit on gold and hold on it until 172 came around. So I wanted to sell out, and we did at a fairly small profit. And then if we see 172 come in again, we'll buy it back. And so therefore, we're just making these strategic adjustments based on what the math of the market is telling us. The other thing that the math of the market is telling us is what's going on with interest rates. And so, as you know, every morning I get up and I do the calculus of the market. And I don't know if you can see this right here, 10-year 0.71. So this morning at whatever ungodly hour it was, the math of the market suggested that the top end of the 10-year cycle, the 10-year interest rate cycle, was 0.71%. What that meant is that if we saw 0.71%, we wanted to buy even more treasuries. We wanted to buy extended duration treasuries. We wanted to buy intermediate term treasuries, because that was suggesting that the bond market was positioning itself for a movement then down to the other side of the interest rate cycle, which the other side of the interest rate cycle, as you can see, was 0.63%. So if we get 0.63% on the 10-year treasury, that's where you sell. If you get 0.71% on the 10-year treasury, that's where you buy. Well, what happened today? Well, this morning we woke up and interest rates, for whatever reason, doesn't matter. I don't care. What I care about is what is the math telling me, which again is driven by the volatility of that particular asset class. We saw the MOVE index, which is the measuring component of treasury bonds, come all the way down to a 3 handle, which is incredibly bullish, but it moved up slightly. So that increased the odds that we'd see a bit of a spike in interest rates. Well, what did we get to? We got the 0.72% on the interest rate. We were buying at that point TLT down in here. We were buying EDV down in here. And we were buying IEF, which are intermediate term treasuries, down in this range here, 2150-ish range, and just simply building out our portfolios focused on these treasury holdings, because that's one of the only asset classes that works inside of a quad 4 deflationary environment. Equities struggle in that kind of an environment, and the reason is because volatility is just not able to get squeezed out of a quad 4 deflationary cycle. There's a number of other reasons, of course, too, but deflationary is death to a business. You've got an environment where very few people are going out and buying because they anticipate lower prices for whatever it is they're trying to buy, that deflationary spiral. But when we look at volatility measurements in the market, and I'll show you VIX real quick here. So here's the basically the S&P 500's volatility measurement. One of the things that we've said is that the VIX, or the volatility measurement of the U.S. equity market, was range bound between roughly 24 and 30. If you break above 30 on the VIX measurement, really bad things have a tendency to happen to U.S. equities in the short term. Now, when I say that, a lot of people will respond with, well, yeah, but the Fed will come to the rescue. Well, if you've noticed, the Fed doesn't come to the rescue until all those bad things are either happening or have already happened. They don't come with more stimulus. They don't come with more, bazooka blows of their big gun of money or anything like that. I don't want to go through that particular kind of an equity price swoon. What I would rather do is be safe in terms of how the asset base is held, and then make some money on those asset classes that do well in a very bad equity base environment. So we've got this situation where U.S. equity volatility measurements cannot seem to get below this 26 level. Now, why is that important? Because 26 is the trend support level for volatility of volatility. If we stay above that 26 and trend higher into this 30 range, which we would anticipate, you're going to see U.S. equity prices come down. And I'm of the belief that's exactly what's going to happen. Because volatility of volatility doesn't lie. The math of the market is what the math of the market is. And if there's anything happening right now, it's piles and piles of noise going on from every corner. And what's great about math is it's black and it's white. It doesn't matter what's going on with noise all around us. So what we're doing is simply risk managing the current environment within the lens of the phase transition of the economic cycle from potentially stagflation to deflation. The probability of a deflationary environment, or that quad 4 that I've talked about so much in the past, continues to escalate. We started out about 2 weeks at about 40%. Last week we were up to about 43 or so percent. Today we're higher than that. And so the three main things that we're continuing to look for, again, are falling oil, rising dollar, and an inability for NASDAQ volatility to come down away from an extremely elevated level. And so I'll show you NASDAQ volatility real quick. So this is NASDAQ volatility. And you can see we're right near about that 35 range. Again, anything north of 31 is above trend. And so therefore we know we're trending. You know, we had a trending and non-episodic bouts of volatility going on here, and then all of a sudden this happened, and then it just kind of went brr. And now I think that we've entered into a new phase of trending volatility measurements on the high end. And one of the things that's interesting about equity volatility as it focuses on the S&P and the VIX is that it is green. In other words, it's positive today. VIX is going up alongside the price of the index that it essentially tracks going up, while at the same time volume for that index as represented by the SPYs is pretty low, what we would call decelerating at this point. So that's all a bunch of stuff that just doesn't typically point towards awesome pricing in the near future. Oil, as represented by Brent crude, you can see not good, off 2.5% today. The U.S. dollar about flat. So you can see yesterday the dollar was all over the place. And then we started to see it move a little bit higher, and then now today it's kind of flat to low. So we'll see how that develops, but it would appear, based on the math of the market, that the dollar wants to trend itself higher. Dollar today is trading below 94. The math of that particular calculus keeps moving the floor of that bottom area of the dollar expectation higher. And so when you see the bottom level of a mathematical calculus of price volume volatility on an asset class move higher, what that's telling you is it's suggesting that that asset class is probably going to move up, which is one of the main reasons why I covered our U.S. dollar short at the profit that we did. Currencies don't move a lot, so when they move 0.5%, we want to take advantage of that, and so therefore we took our profits at that level. So again, NASDAQ volatility, not where we want it to be. Oil is falling. That's a very hypersensitive, high-frequency indicator of what's happening with the potential of deflation, and the U.S. dollar positioning itself mathematically for what appears to be that phase transition that it wants to go up in. And so we'll see how it develops. But what I don't want to do is sit around and wait for the Fed to somehow magically try to rescue equity investors that are all of a sudden down 5, 10, 15, 20% before they knew what happened. Markets are in a very potentially fragile environment right now because volatility measurements are in the wrong regime. They are currently trending on a higher basis after having hit trend support. And again, I'm talking about the volatility measurement, along with, at least in the last couple of days, pricing on those indexes moving up. That's not the stuff you want to see. That's exactly the same stuff we saw at the end of August before September broke. So again, we'll just continue to keep risk managing the environment. We've increased our exposure to U.S. Treasuries, both short intermediate, long, and extended duration, because those asset classes do great typically within that quad 4 deflationary environment. And we would anticipate, for example, I'll show you this last one, we would anticipate based on a movement in TLT, the math suggests that we could get up to 165, 166 on this long duration treasury before the interest rate move is over. So, if we see the price of that get back up and near that range, then we'll start to take some profits down on the bond side and see how it goes. We have to remember there's a lot of negative interest rates all across the globe today. We're currently watching what we would call the anchor men of the bond market on a global scale, the Swiss 10-year treasury and the German Bund, which is their 10-year bond, both yielding very, very deep negative interest rates right now. The Swiss 10-year treasury is trading almost at a negative 0.6%, which is really low. So could we see that? Yeah, it's possible. Very, very possible. If you don't know what MMT is, modern monetary theory, you might want to go take a peek at it. And the only reason I say that is it appears that our government on either side of the equation, it doesn't seem to matter anymore which side of the aisle, they seem to want to attempt to see what MMT is about. Now, I'm not a fan of it. I don't think it works. I think it ultimately ushers in a very negative degree of inflation that is going to be hard to deal with. We'll risk manage around it just like we did this last bout of inflation, so it'll be okay. But for the average citizen, I don't know that they're going to be ready for it. And long term is that has a very negative effect on the dollar. So I would suspect at some point, once we're through quad 4 and the dollar's done going up, that we'll put a longer term short on that dollar, and it will do quite well as part of the portfolio. So at any rate, if you have any questions at all, let me know. Just a very quick update for you on what we're doing, where we're at, and what the fourth quarter is looking like. And I'll continue to do these videos until you are not excited to see my mug anymore. Thanks so much for your time. Thank you for allowing me to continue to work for you, and hope you have a blessed day. See ya.